The crisis in Ukraine has Europe's big banks reeling. Financial stocks tumbled in the hours after Russia began its invasion of the country. By early afternoon Thursday, the Euro Stoxx banking index was down around 8%. Lenders with big operations in Russia were hit much harder. Austria's Raiffeisen Bank was down almost 20%. Italy's UniCredit, one of the biggest lenders in Russia, fell over 11%. The impact was little surprise. European financial institutions are more heavily exposed to Russia and Ukraine than rivals anywhere else. Germany's Deutsche Bank said it had contingency plans in place without giving details. It's been reducing its presence in Russia as sanctions ramped up. Allianz, one of the world's biggest asset managers, said it had already reduced its holdings of Russian government bonds. In the UK, Lloyds said it was on alert for cyber attacks. Bank boss Charlie Nunn said the industry held talks on cybersecurity with the government on Wednesday. Now lenders wonder how they will be affected by sanctions imposed on Russia. In one glimmer of relief, the EU is thought unlikely to cut Russia off from the SWIFT system of global interbank payments. Any such move could disrupt the world financial system and make it hard for creditors to get money out of Russia.
Alibaba reported its slowest ever rise in quarterly revenue on Thursday. They rose about 10% to just over $38 billion over the October to December quarter, below analyst projections. It was a sign the slowing Chinese economy has hurt the e-commerce giant, with consumers saving up and spending less. The warning signs were clear in November when one of Alibaba's major events, Singles Day, reported record low sales growth. Alibaba also faces more pressure from rivals like TikTok owner ByteDance in the e-commerce space. It all adds to pressure on the firm as it deals with a large restructuring imposed by Chinese authorities, who stopped its $37 billion initial public offering in late 2020. In better news for Alibaba, international commerce was up almost by a fifth, while local consumer services were up 27% on a year before. Global markets dived and oil prices rose on Thursday as Russia launched an invasion of Ukraine. Investors worried that a major war in Europe could hurt the economic recovery from the health crisis and disrupt global energy supplies. Markets in Europe opened with the Stoxx 600 index falling to its lowest level since May last year, 10% down from January's high. The German DAX felt most of that selling pressure due to the country's reliance on Russian energy supplies. The index was down just under 4% in early trade. In Russia itself, the MOEX stock index slumped more than 40% after an initial halt to trading was lifted. The ruble fell 7% to an unprecedented record low, while the euro also dropped to a multi-year bottom. That as investors sold off the currencies and moved into safe havens. Gold, government bonds and the Swiss franc were among the winners. Commodity investors also saw turbulence. Oil prices broke above $100 a barrel for the first time since 2014, with international benchmark Brent crude reaching just under $104 after the attack began. Asian investors also felt the pressure. The MSCI's broadest index of Asia-Pacific shares outside Japan fell more than 3% to its lowest level since November 2020. Tokyo's Nikkei closed almost 2% down. Markets will now watch to see how the United States and its allies react. US President Joe Biden said the country would impose severe sanctions on Russia. Europe's leaders also said they would freeze assets and shut Russian banks out of its financial markets.
After an early morning sell-off following Russia's all-out invasion of Ukraine, all three major indexes roared back on Thursday, with the Nasdaq closing up more than 3% after U.S. President Joe Biden unveiled harsh new sanctions against Moscow for launching an assault on its neighbor. The Dow was the last to turn positive on Thursday, closing up more than 0.25% after an initial 800-point slide. The S&P 500, which earlier this week slid into correction territory, gained 1.5% by the end of the day after falling more than 2.5% in early trading. And the Nasdaq soared after Biden's speech, finishing up a whopping 3.3% after losing about as much at the start of the session. Wealthwise Financial CEO Laureen Gilbert said given the escalation in Europe, it's possible the U.S. Federal Reserve might take a softer approach to raising interest rates.
Pundits have been talking about what would it take to have this Fed put and for the Federal Reserve to change their course from raising rates. And so the question here is, does this escalation cause the Fed to change their course? I think a couple of weeks ago, we were sitting at a very high probability of a 50 basis point increase in March. And now that probability is going way down and more towards that 25 basis points. So that is going to appease the markets if in fact we do see either no rate increase, which I doubt that that's going to happen, but even a 25 basis point increase at this point would appease the markets.
The whipsaw session reversed the fortunes of Tesla, shares of which were down as much as 8.4%, but closed up nearly 5%. Earlier, the Wall Street Journal reported that the U.S. Securities and Exchange Commission is investigating whether recent stock sales by Elon Musk and his brother violated insider trading rules. Shares of Apple were down more than 5% at its lows, but recovered to close up more than 1.5%, climbing along with other mega caps including Amazon, Microsoft, and Meta Platforms, which all saw big early losses but then finished up well over 4%. Microsoft closed up 5%. But perhaps the most spectacular percentage spread during Thursday's wild session belonged to DraftKings, which started the day down more than 7%, only to finish the session up more than 11%.
Mark Zuckerberg's Meta mapped out key steps to building the metaverse on Wednesday. It hopes to use artificial intelligence to let people generate virtual worlds by describing them through speech, improve voice assistance, and translate between languages.
So the demo you saw today is
Meta's vice president, Jérôme Présenti, said the tech isn't far away.
we are creating tools today to help people generate new worlds. And these tools will be AI assisted. So that technology, you can see, come into products in the coming years. This is not like far off completely of technology.
Meta recently lost a third of its market value after a dismal earnings report. Zuckerberg is investing heavily in the metaverse, a futuristic idea of virtual environments, and betting it will be the successor to the mobile internet. We can't say exactly when that'll happen, but for now, he said Meta is investing in AI research that will allow people to have more natural conversations with voice assistants, adding, quote, "As we advance this technology further, you'll be able to create nuanced worlds to explore and share experiences with others with just your voice." Zuckerberg also announced work on a universal speech translator and generating a first-person experience within the metaverse.